Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
President Joe Biden hailing a new era in U.S.-Vietnam relations this weekend. Speaking at a business forum, the president said the two nations were deepening economic cooperation, particularly when it comes to cloud computing, semiconductors, and artificial intelligence. It comes as Vietnam elevated U.S. to the highest diplomatic status.
It's about investing in the dynamism of our societies, about creating opportunities for our students. It's about building secure supply chains for our small businesses. It's about creating a free and open Indo-Pacific for all our people, This new partnership is, I think, going to help unleash the potential, our people's potential, and with it a range of possibilities we haven't even thought about yet sitting here.
Well, the president announced a number of trade deals during his visit, including Vietnam Airlines buying 50 Boeing jets and Microsoft announcing AI plans tailored for Vietnam's emerging market. Here to discuss more is Ali Wine, macro geopolitics senior analyst at the Eurasia Group. Ali, it's good to talk to you today. Put this in context for us first. This elevated status the U.S. now has with Vietnam, the announcement of these deals. How significant is it when you consider the historical relationship with Vietnam and where China is today?
Well, thanks very much for having me on. It's historic for the reasons that you mentioned, given the state of relations between the United States and Vietnam just a few decades ago. It is historic. And I think, as you said, it's important to look at these deals that are being signed in a broader context. The United States has prioritized the Indo-Pacific. It believes that the Indo-Pacific is the most significant theater of strategic competition, and it's trying to bolster its influence in the region. Now, the principal way that the Biden administration has been doing so up until now has been to strengthen U.S. relations with its allies in the Quad. This is Australia, India, and Japan. But the administration wants to ensure that it's committed to the entirety of the region, and it doesn't want smaller countries in the region to feel that they're being left out. So the administration, in parallel with its efforts to boost the Quad, it's also deepening its engagements with a number of member countries of ASEAN, including Indonesia, including the Philippines, and of course, Vietnam. So what we see is two parallel lines of effort to bolster America's presence in the Indo-Pacific.
Ali, what kind of response do you think we'll see here from China, given the fact that this really just shows us how Biden is looking at the geopolitical relationships here going forward and how he's calculated being able to get to those regions, secure products that the U.S. needs, that U.S. companies need, without relying, obviously, as much on China?
Well, China is going to be vigilant. China is going to be concerned because, keep in mind, China is not only facing growth headwinds at home, and those growth headwinds, of course, are a critical source of China's influence in the Indo-Pacific and beyond. But China also recognizes that there's a growing coalescence of opposition to China in the region, in the Indo-Pacific, that is, but beyond. And we just to give one example, we saw a few days ago that China published a new map, its so-called 10-dash map, and that elicited a lot of concern from many neighbors with which China has maritime disputes and other territorial disputes. So China is going to be vigilant. I think China also recognizes, though, that many countries in the region, including Vietnam, they're wary of openly aligning too strongly with either the United States or with China. They want to balance security ties with the United States, but economic ties with China. And so Vietnam is undertaking a very difficult balancing act.
What does that tell you about the increasing importance of the region then? If you've got a country like Vietnam, but really ASEAN nations broadly being able to say, look, we are able to play both sides, it seems to point to the significant or growing significance of that region.
No matter what metric you consider, whether you look at share of the global economy, whether you look at the share of global defense spending, the share of the global population, no matter what metric you consider, the Indo-Pacific today is the center of geopolitical and geoeconomic gravity, and it will continue to be so. And to your question, I think what's interesting is one of the narratives that we often hear is that countries in the region will have to make a choice, a so-called strategic choice, in which they pick only the United States or only pick China. It's a very common narrative. And I think that what a growing number of countries in the Indo-Pacific are demonstrating is they're flipping the script and they're saying, one, we don't accept that choice, and two, we can actually leverage intensifying U.S.-China competition to our advantage. So if the United States is courting me, if China is courting me, it enhances my freedom of foreign policy maneuver. It gives me more trading and investment opportunities. So Vietnam is demonstrating how we can flip the script in the region and how smaller countries in particular can capitalize on intensifying competition between Washington and Beijing.
Ali, how significant is it for the U.S. companies that we talked about there with these deals when it comes to Boeing, Microsoft, NVIDIA? How much more exposure do they potentially get from this, or is it more of a geopolitical aspect?
Well, increasingly, business considerations and geopolitical considerations, I wouldn't go so far as to say that they're one and the same, but they're increasingly intertwined in a way that would have been difficult to imagine even a decade ago. And we certainly see this in the case of China. One of the considerations or the dilemmas really for many companies is many companies have significant extant operations in China, but they also recognize that the investment climate in China is deteriorating. We see the crackdown of China's leadership on the investment climate in China. So for many companies, they're aware of a deteriorating investment climate in China. They're aware of intensifying competition between the United States and China. And so you can't take these existing operations in China and get rid of them overnight, but you are looking to diversify more actively or to de-risk more actively. And so I think that Vietnam is going to be one of the principal beneficiaries of that de-risking approach. I think Vietnam will be one of those countries. India, which just hosted the G20, I think will be another beneficiary. So this process is not going to occur overnight, but over the medium to long term, I would expect more and more multinational corporations to de-risk and diversify away from China.
Let's talk about the G20 really quickly here. That joint declaration that came out refusing to condemn Russia specifically for the Ukraine war. What does that tell you about the divisions within G20? And more importantly, the questions going into this summit, how effective the G20 really is?
So I think that there are at least two interpretations of the language on Ukraine. Now, obviously, the language on Ukraine in this year's G20 communique was softer than the language in last year's G20 communique. One interpretation is it's a reflection of how divided the G20 members are on the issue of the war, and that's one interpretation. I think that there's a second interpretation which hasn't gotten as much attention, but I'd like to at least mention or broach. And the second interpretation is that India, which is increasingly casting itself as a champion of developing countries, a champion of the global South, it didn't want the Russia-Ukraine war, and it didn't want geopolitical frictions more broadly to overshadow the priorities of developing countries, including pandemic preparedness, debt relief, climate finance, and the like. And I think that what we see in the joint statement is an acknowledgement, of course, of the enormous suffering that Russian aggression has imposed on the people of Ukraine, of the enormous consequences that the war has had for food and energy markets, but also a very deliberate effort on the part of India, the United States, and others in the G20 to elevate and spotlight the concerns of developing countries. So there are at least two interpretations, I would argue, of the language on Ukraine.
Ali Wine, it's good to get your perspective today, joining us from the Eurasia Group. Appreciate the time.
Thank you for having me.
Well, consumers and investors waiting for Apple's expected iPhone launch tomorrow. Jared Blickery is here with a closer look at how Apple stock usually moves around these types of events. What should we expect?
Sean, it's usually a sell the news event. Right now we have Apple up just marginally, and this is what usually happens the night before the event and then the morning of, and then you get to the event and we sell off. I'm going to show that in a second. Just want to show all the green on this Nasdaq 100 screen. Here is a look at Apple over the last 6 months. As I've been talking about over the last few weeks, this big drop here into oversold territory, that was the biggest such drop from a record high that we've ever seen in Apple. Never happened before at that speed. Now we experienced another big down day last week, and we're just trying to recover from that. But having said that, we're only down about 10% from record highs, so not like a disaster is impending here. But I did want to show some of the negative seasonality surrounding Apple stock, and I went all the way back to 2007. Might remember that's when the iPhone 1 was first announced at the June Worldwide Developer Conference, and that purple line right there is Apple stock, and then this red line right here is what happens in the overnight market. You can see it generally drifts higher. And then the orange is the full day return, while the cyan is the day session only. So you can see that when you average when you add the red to the blue here, you get the orange. That's a full day return. What you need to take away is that it tends to drift lower over time. Although I would say last year in September, and these events have moved to September over the years from June. Last year, we actually saw a little bit of an uptick. Regardless of what happens tomorrow, I've also been tracking what happens historically in the entire month of September. As it turns out, September has always been bad for Apple stock for whatever reason, going back to its debut in 1980. If you had invested $1,000 and only spent it in September, going all the way back to 1981, the first full year of trading, you would now have about $80. That's a loss of 92%. Now, you look at how it's bookended by August and October here, 637% for August, 750% for October. If you're holding out for October, waiting for that big bump up, just consider that August was a negative month for Apple, so it's already bucking the seasonality here. There could be reasons for that, declining revenue. I've talked about that at length, but just to get back to the fundamentals here, what we can expect for the big day tomorrow, probably see a little drift overnight. I have seen that on the day of the announcement, we do get a little fireworks in the stock when things are announced, but for the most part, it is a slightly sell the news event, certainly not a catastrophe, guys.
All right, well, investors got to hold on to that stock if we're going by historical standard here, at least through till October. Right, Jared? Thank you. Well, coming up, the IPO market is heating up. ARM is considering asking investors to up its valuation, and Instacart has set an offer price range. We will discuss all this on the other side. Pandemic darling and online grocery app Instacart kicking off its IPO, disclosing the price that it hopes to get for its stock in a new filing. Yahoo Finance's Josh Lipton joining us now with more, making your 3 to 5 debut. Welcome.
That's right. Thank you, Shauna. And this is a great start because this is a company, a name that many of us know and many of us still rely on. And now it is also, of course, a hotly anticipated IPO. We're talking about Instacart. In a new filing, the company and selling shareholders aim to sell 22 million shares at $26 to $28 a piece, raising as much as $616 million, with 331 million shares outstanding when including shares to be issued to employees and execs. That translates to a fully diluted valuation of up to $9.3 billion. That, of course, is a big reported drop from the $39 billion valuation Instacart secured in a funding round a couple of years ago. We all remember Instacart as a go-to service during the pandemic. A lot of people came to depend on for their grocery deliveries. In the first 6 months of the year, Instacart reported $1.5 billion in revenue and $242 million in profit. That is an improvement from the year ago period. That made some headlines, remember. Tech companies, as we know, don't always take the public market plunge with a decent bottom line. On the other hand, analysts note that growth has slowed. Now, Instacart will argue they are lapping some tough comps, including from COVID, and also point to near-term economic headwinds like inflation. But analysts argue competition is also a likely factor here. Instacart says potential rivals include everyone from Walmart to Amazon, Uber to DoorDash. Instacart filed for the IPO as Maple Bayer is expected to trade on the Nasdaq under the symbol CART. And you can bet traders, investors, and bankers will all be watching closely and wondering whether this public debut, if it's a winner, could help heat up the IPO market here. Shauna, back to you.
We will see, and we're going to see very soon. I like their ticker, CART.
Simple.
It's going to be one of my favorite ones.
Gets right to the point.
It does. Yeah, exactly. No confusion there. All right, Josh, thanks so much.
You got it.
Well, the 2021 IPO boom led to a banner year for retail investors and the companies that raised more than $140 billion. But as markets pulled back in 2022, so did the market for listings. That's starting to shift, though. According to Renaissance Capital, filing activity is up almost 27% from last year after Kava's big IPO and a volatile start from Vietnamese EV maker VinFast. Investors are looking to SoftBank's ARM and, yes, grocery delivery app Instacart to keep the momentum going for IPOs. Joining us now is Kyle Stanford, PitchBook Senior Venture Analyst. Kyle, good to talk to you today. So let's start with what we have learned from Instacart and this filing. I mean, last funding round in 2021, when they were still a private company, $39 billion. Now they're targeting upwards of $9.3 billion. What does that mean for some of those companies that are waiting in the wings? How much is riding on Instacart's performance?
Sure. So I think the first thing it shows is just the difference in the market between 2021 and now, right? It's not like Instacart's revenues have declined. They've continued growing at a very fast pace for most of it, or for a couple of years now. But the revenue multiples and sales multiples that these companies were getting priced off in 2021 were astronomical compared to now. We have a VC-backed IPO index that tracks these for recently VC-backed companies. And in 2021, it was upwards of 30x. Now it's down to about 4 or 5x, right? Which is even a little more than what Instacart's going to get. But what that does say is that even these companies and many other unicorns that will hopefully be coming through the system after Instacart are looking at a very challenging market, right? At about a quarter of the valuation for Instacart there. That's not necessarily a huge sign of success, but a strong performance in this IPO is going to generate a little more interest for VC-backed companies. We saw Klaviyo that might be going out the same day or soon after. They can also continue the momentum forward. And, hopefully these two can get a few more companies to start to list and test these waters now.
Kyle, if we do see a successful IPO here from Instacart, and if we do see one from Klaviyo as well, I guess when you talk about that pickup in activity, how much of a pickup are you expecting to see, given the fact that the macro environment right now is still a bit challenging?
Yeah, right. I'm not sure it's going to be a wide open window like many are hoping, right? That's what the market is really love. And a lot of investors would love to see that, but it doesn't seem like that's going to be anytime in the near term, because you're right. Interest rates are still very high. They're still maybe going up a little more. Inflation is still really high. All of these indicators are much opposite from what many of these unicorn companies have we're seeing when they raised in 2021 or even early 2022. So I expect a pretty calm market, calm re-entrance of the market through this year if Instacart goes out well, but I don't think there's anything that really indicates to us that it's going to be a full-fledged rush back to the IPO market.
So what is the conversation that's happening among these VC-backed unicorns? I mean, we talk about the valuation drop for Instacart, even though the fundamentals for the company didn't necessarily change. Does that provide a reality check to some of these private companies that are maybe looking to come to market who say, okay, this is the reality of what we should expect? Or do they choose to stay private for longer because there's more money to be had from the private side?
So that is something that is actually going to be a really big challenge for companies going forward. There's not as much money in the private markets now as there was a year ago or 2 years ago. And so that option is not necessarily there. So what these companies will be looking for is, all right, what is the pricing that they're able to actually expect in the public market? Is it going to be a 20 or a 50% down round? Is it going to be, roughly flat to what the valuation they raised at their last round is? That's going to be a big indicator of which companies are able to, make this jump in this market. In both Instacart and Klaviyo, they both switched from money losing to, a money making business, which is what investors are looking for. So there's a lot going on, but that stay private for longer is not necessarily going to be a good option either. We have over 51,000 private VC-backed companies in the, currently still private, which is, a huge number. And when we see what happened to, some of the large non-traditional investors when the market crashes, they pulled out of VC pretty quickly. And so those late stage and venture growth stage companies that are right on the cusp of moving public or finding an exit do not have the same private capital availability that they were looking at 2 years ago. And so they're really in a difficult spot. And so we haven't seen any companies really be forced to exit yet. I think there's been a lot of conversations for companies in crowded markets, whether there should be some M&A consolidation, or maybe they should take an exit now rather than try to continue moving on and growing in the private markets and hope for a turnaround in the next year. It's a really difficult private market right now, and that capital availability is something that is not there. So trying to find an exit, whether that be through an IPO, Instacart will give a good idea of what pricing should be.
And Kyle, given the fact that it seems like they have very, very little options or few options or attractive options, I should say, at this point, when you talk about some of that M&A pickup, or maybe more will be forced to turn to M&A, is this more of a tech-specific story, or do you think we're also going to see that play out across various sectors?
Yeah, right. I think when we look at what happened in 2021 and the exuberance in the market and the number of companies that were getting funded in every category, this is not going to be necessarily a tech-specific problem. There, you look in healthcare, you can look in tech especially, but any of these markets, they're very crowded right now. Again, 51,000 companies is well more than we've ever seen currently privately backed. And with fundraising levels pretty low through the first half of this year, and going through Q3, there's not going to be a resurgence in capital availability. So it's not going to be a tech-specific problem the way we see it.
Kyle, finally, I'm kind of curious to get your take on the ARM IPO. There's a lot been made about the limited number of shares that will be available on the public market, how much SoftBank is actually hanging on to. I mean, this is a company, yet again, that was, got big bump from SoftBank in the massive share that they have. And yet at the same time, there's a lot of interest in these chip makers, particularly around the enthusiasm around AI. How do you sort of weigh all the factors going into this IPO?
Sure, yeah, ARM's a very, very interesting case. And I think one thing that SoftBank is looking to do is really keep that cornerstone investment in their portfolio. They had Alibaba for a very long time, and they were able to leverage their stakes in Alibaba to fund a lot of these other initiatives that they were looking to do, whether it be the Vision Fund, whether it be adding more capital to Vision Fund 2. They were able to do that through that stake. And ARM, they believe, is going to be a cornerstone investment for their portfolio moving forward. Maybe it won't return what Alibaba did, but they're keeping a very tight grip on them because they know that this is a very well-established company in many major markets. It's not a VC-backed IPO looking for growth, but it is very profitable. It is driving a lot of interest, and with the AI boom and SoftBank really digging deep into their AI strategy, They think ARM is going to be, what helps them continue to fund these initiatives and continue growth for themselves moving forward.
Kyle Stanford, PitchBook Senior Venture Analyst. Good to talk to you. It'll be interesting to see how these IPOs perform. Appreciate your insight.
It will be an interesting couple of weeks. Yeah, thank you.
Well, coming up, what kind of economic impacts are we likely to see if the U.S. government shuts down come that October 1st deadline? We're going to discuss the potential fallout on the other side. We'll be right back. The countdown is on to avert another government shutdown with less than 12 days left on the legislative calendar to clear a spending bill. But with House Republicans divided and a split Congress, it's looking more and more likely that we could see a shutdown. Joining us now is Jeanette Lowe, Strategic Securities Policy Research Managing Director. Jeanette, good to talk to you today. So where do you put the odds of a potential shutdown right now?
Hi, well, thanks for having me. So our current odds are very high as well. So 75% chance as of today that we do have a government shutdown on October 1st. Because the House and the Senate are coming at government spending for the current fiscal year for FY24 at different levels, there's only a couple of weeks before they have to pass the budget by September 30th, and they could pass a continuing budget resolution in order to continue current funding, or we would go into a government shutdown. And one of the problems with having them try to pass a continuing budget resolution, which they have done many times in the past, is that the House conservatives are currently asking for other policy provisions to be attached to it, things like border security that are just not going to pass on a bipartisan basis. And because of this stalemate, we do think it's more likely currently that we will have that shutdown.
Jeanette, if we do see a shutdown, what are the economic implications of that?
So, we've looked historically at government shutdowns in the past. They've varied in how long they have lasted, but in general, government shutdowns have not had a significant impact on economic growth or on the stock market. So the last 6 government shutdowns have occurred in quarters with positive economic growth. Usually they do last a little while. The government reopens. That spending that was supposed to be done during those weeks does come back out. So it's had a very modest impact. The one thing that we're watching for with this current shutdown is, would Moody's potentially put the U.S. on a credit ratings watch during the shutdown because of it? They've been saying, the credit agents have been saying that process is becoming more important with things like the January 6th event, with the debt ceiling fights that we continue to have, and the government shutdowns. And that's the potential where we see more risk, is if we do actually have that credit watch come into play, that would be a much more significant event for financial markets in our view.
Would that have any bearing, though, you think, on negotiations in D.C.? I mean, certainly that doesn't seem to have made an effect when you consider what Moody's did, what the credit downgrade has meant for, how lawmakers in D.C. have been watching this. I mean, there have been warnings about the political gridlock that's been existing.
Right. And to your point, it hasn't actually led to much action yet out of Congress. There is a lot of talk on both sides about having to now address this, but it hasn't really moved it forward. The one thing that I do see is that if we go into a government shutdown, they usually, let's say, last about 2 weeks. In this case, like looking back, it's very similar to what we saw in the October 2013 government shutdown. That one lasted 16 days. This one's kind of setting up to be a very similar situation. So if Moody's were to do that, that actually could be a catalyst for the government to at least reopen, because usually shutdowns end as political pressure continues to build on both sides to then reopen the government. And so that's where we could see it really being a catalyst to have some action. And then it's still up to Congress to decide how they actually want to deal with some of the larger fiscal issues that the U.S. is facing. But that is where it could actually play a role in actually helping to reopen the government, even though it's not exactly the best catalyst to have that effect.
Jeanette, what's the risk to the Biden administration on one hand? And then on the other hand, when you take a look at Speaker McCarthy and the pressure that he's under, a number of Republicans want him to reach a deal. And then you have the far right saying that they want him to hold that hard line. What's at risk here when you take a look at those two parties?
Yeah, so it's interesting, so presidents generally in the third year of their presidency, they hit a low in August of that year in their presidential approval ratings. And President Biden has had very low approval ratings, hovering around 41%. We actually do think, though, that if there is a government shutdown and it allows President Biden to kind of retake the bully pulpit and stand up every day and say that wants to have the government open and that Congress is standing in his way, that actually could be a benefit to his approval rating and give him a boost going into the re-election cycle in 2024. On the other side of that, though, you do have some risk here for Speaker McCarthy. There is definitely some House conservatives who are quite disappointed in what he's been able to accomplish as Speaker. If he were to cross and go with the Democrats in order to pass a measure to keep the government open, that would definitely cause people to want to move to remove him as Speaker. We definitely don't see an alternative for the speakership as of yet, but that is definitely a risk that he faces. So he needs to kind of thread this quite carefully. Now, he has exceeded expectations in the past, but it could be that the government shutdown, one of the main consequences is that it does hurt his ultimate power in the House.
Finally, Jeanette, another story we've been following closely in the context of U.S. and China is this reported ban on iPhone use for Chinese government employees. At the same time, we saw Huawei come out with a new phone that has raised questions about, whether in fact China is a little more ahead than expected in their advanced chip development. What do you think, or how do you think the Biden administration response to this, given that the expectation was those export controls that were in place for a company like Huawei would really stifle any kind of advancement and innovation in that space?
Right. So this is really important because, the restrictions came a week after the Commerce Secretary traveled to China to have better relations to some extent. Now, while I do think that the U.S. is trying to keep lines of communication open, I do also think that the Commerce Secretary was also quite clear that the U.S. is concerned about the way China treats U.S. businesses in that country, and that the U.S. is also concerned about national security things like emerging technologies, semiconductors, AI, things like that. And so it's also showing that the U.S. administration is not going to, walk back these export controls. Then having China actually make this announcement a week later just kind of signifies even more to the U.S. that they almost need to double down on these export controls. The Commerce Secretary and her department are going to investigate as to how China developed the 7-nanometer chip that is in the Huawei phone. Was that something that happened before the export controls went into place? Was it something that evaded export controls? Are the export controls ineffective? And that's going to be something that the House, Senate, and the administration is going to be looking at quite closely. And just in the few days since that announcement happened, you were definitely seeing bipartisan calls for more controls on China to really kind of prevent some of these technologies from getting there and taking a tougher stance.
Yeah, I'd imagine some questions could pop up tomorrow as well with Apple and their event with the release of the new iPhone too. More to come on that story. Jeanette Lowe at Strategia. Good to talk to you today. Appreciate the time.
Thank you.
Well, coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending tickers. Stay tuned. And there you have it, the closing bell on Wall Street on this Monday to kick off the trading week. Let's do a quick check of the markets, sponsored by Tasty Trade. Green across the board, at least on this Monday. The Dow up 88 points, the S&P 500 up 30, and the Nasdaq up 156. Tech names certainly giving the Nasdaq a big boost there. But in terms of sectors, that saw the biggest gains today. Consumer discretionaries as well as communication services seeing the biggest gains. Let's see if we can do a quick check of where bond yields were, again, as there are more questions about where the Fed moves in its next meeting. Taking a look at where bond yields are, we saw the 10-year yield moving up at 4.28%. Well, we are watching shares of Tesla jump after Morgan Stanley analysts predict the stock could hit $400 a share, citing the potential of the Dojo supercomputer that the EV maker is developing. The analysts see Dojo unlocking new revenue streams for the company through robotaxis and software services, potentially adding $500 billion in market value. And Sean, as we were saying at the top of the show, this isn't really just about the auto space, at least according to the note. It is about Tesla being able to add significant revenue beyond the current space that they're in. And you made a good point earlier on that, Morgan Stanley specifically sees this is an AWS-like moment for Tesla. What we saw with Amazon, of course, AWS, the big driver there, and Morgan Stanley seeing Dojo being a big revenue driver moving forward. They do say it is about software for the company.
Yeah, all about software, and also making the case that Tesla should be valued like a tech company. We know we have talked to so many analysts that go back and forth just in terms of where they stand on that argument. But Adam Jonas there at Morgan Stanley saying that Tesla here should very much be valued like a tech company because of Dojo, because of some of their technology, their AI capabilities, self-driving technology that really put it in a class of its own when you compare it to some of the other automakers out there. That 10% gain that we saw in the stock today was its largest intraday jump that we've seen since January. So we have a 10% here move to the upside. This is a stock that has certainly rallied since the start of the year. We're still below those record highs, but Adam Jonas thinking that Tesla won't have a problem getting back to those near record high levels anytime soon, with his price target substantially higher than where we closed, just around $273 today. Let's take a look at Disney closing in the green, up just over 1% after reaching a deal with Charter Communications, owner of Spectrum Cable. The agreement ending a dispute that left over 14 million Charter customers without Disney TV channels that included ESPN, FX, and the Disney Channel. The deal comes ahead of tonight's first Monday Night Football game of the season. These were negotiations that were down to the wire. Lots of question marks about whether or not a deal was going to get done. But what we want to point out is what's on your screen right now and what is included in this new deal, because both companies really saying that this really shows where the media space is going in the future. And this new deal is going to be the Disney Plus Basic will be included in some Spectrum TV packages, and then go on to say that ESPN Plus and also the ESPN DTC service will potentially be available to Spectrum TV Select subscribers down the line here. So Akiko, this new package deal integrating obviously the traditional linear TV, but then also streaming, which we know is so important in this day and age.
Yeah, we're talking about 15 million subscribers that have been affected by this blackout that has continued on until today. Certainly, as you point out, a lot of people really happy this came in time for Monday Night Football. But it does feel like in many ways we're kind of at an inflection point right now. When you think about where some of these media companies are, you know, you look at somebody like Charter, they have seen increasing cord cutting, not necessarily a Charter specific story. It's a broader trend that we've been seeing. And then sort of taking it to Disney to say there's got to be more in the package here, because there's got to be a value add for those who are considering that cable bundle when you consider the costs adding up on streaming side alone. So, you know, I get the sense this isn't the last we heard of on a standoff like this, but at least good news for subscribers that, you know, this issue resolved in time for Monday Night Football. Well, RTX stock is sinking today after the company said that it will take about a $3.5 billion hit in its third quarter after the recall of its popular Pratt & Whitney jet engines over the next few years. RTX says that about 600 to 700 engines will be removed for shop visits through 2026, and the majority of those visits occurring in 2023 and early 2024. You look at the stock move there. We're talking about, of course, formerly called Raytheon Technologies, RTX, or it is Raytheon Technologies right there, but RTX, that stock down nearly 8% on the back of this.
And Akiko, they expect a cash impact here of approximately $1.5 billion during 2025. The total hit here just about $3 billion. That's certainly putting a heck of a lot of pressure on the stock today, also cutting their full year sales forecast as well. In terms of analyst reaction, they really want to know that this is the extent of the problem. Benchmark coming out saying that they need to gain confidence that this encapsulates the full scope of the issue. When you talk about a $3 billion hit, at least if you're from RTX perspective, you're hoping that encapsulates the entire issue here. But again, closing off nearly 8% today. Let's take a look at oil, because oil prices trading near their 10-month highs as Saudi Arabia and Russia extend production cuts. But it comes amid a slowing Chinese economy, which could put a damper on demand. For a look at what to expect in the oil market, I want to bring in Tom Kloza, Opus Global Head of Energy Analysis. So Tom, here we are, not too far from the 10-month highs that we saw at the end of last week. How much higher do you think crude is headed?
I'm sorry, I didn't catch your question there.
How much higher do you think we're headed from these levels with crude right just above $87 a barrel?
I don't think we're headed that much higher on crude oil. I think crude oil prices have done the easy work of going up about $16 or $17 a barrel. They may get tugged higher because we have very, very high prices for heating oil, diesel, and jet fuel. And that will be the next chapter. I think most of the increases in gasoline have already occurred, and we're likely to see lower prices in the last 100+ days of the year. But boy, if you buy the middle of the barrel right now, that middle of the barrel has really been choked. We're running a lot of light, sweet shale crude, and you make a lot of gasoline with it, but you don't make a lot of diesel and jet fuel, and that's what the world is short of.
When you look at oil prices broadly, it certainly feels like the supply side story has really been driving the market when you think about Saudi cuts. But I'm wondering what you see from the demand perspective. So much being made about China and the slower growth that we're seeing there. To what extent do we see a further pullback as we see that largest market being pulled back even further economically?
Well, China's been a disappointment. And now that prices are considerably higher, China probably will be importing less crude and exporting more refined products. I mean, their housing business is in a shambles, so it may take a long time. The first time we'll get an inkling of how things are getting repaired might be in November. But we are seeing other emerging markets using more gasoline. India has been gangbusters. And Latin America has been gangbusters for U.S. refiners. U.S. refiners are able to supplement, minimal demand or subpar demand in the United States for gasoline and diesel by shipping products to Latin America. And that could actually get accentuated in the next month or so because Russia is apparently undergoing a lot of maintenance on its stateside refining, and that they've been a big supplier to South America and particularly Brazil.
Tom, how worried are you just about the hurricane season here, what that could potentially look like and the impact it might have here going forward on crude prices? Because the storm so far, at least, we've been able to avoid most of the disruption in supply that we had been bracing for.
Well, I live in Fort Myers 5 months of the year, so I'm really worried about the hurricane season. I can tell you that. I would say that so far we've dodged a bullet, but it used to be that the Strait of Hormuz was the choke point for the world, where 20 million barrels a day of crude would go through. Nowadays, the U.S. Gulf of Mexico is a close second. There were some summer weeks where we exported upwards of 12 million barrels a day of crude oil and refined products. Again, a lot to Latin America. So far, so good. I would say, though, that Hurricane Lee, if you watch those spaghetti strands right now, there's a fettuccine strand that looks like it's going to go up to the Canadian Maritimes. And there's probably the most critical refinery for gasoline and diesel futures is located in New Brunswick, Canada.
So, Tom, moving forward, we were just showing what the average gas price is right now. I mean, are we approaching that $4 mark, you think?
No, I don't think we're going to get to $4. This Friday, the specs change for gasoline in probably 49 or 48 of 50 states. And what happens is the recipe for gasoline changes, and you can basically blend in other hydrocarbons like butane and naphtha and natural gasoline. They're much cheaper than motor gasoline, so you can actually accentuate the volumes and cheapen the prices. So that happens Friday. I think we can look forward to lower prices in the rest of the year. California is a little bit different because they have to use a summer grade gasoline through Halloween. Last year, we saw prices go above $6 there in early October, and the administration, through the Environmental Protection Agency, acted to alleviate some of those specs. So I think the worst is over for gasoline. And again, we're going to be running so much light, sweet crude. It tends to have a high yield of gasoline, just doesn't tend to make enough diesel, heating oil, and jet fuel.
Tom Close, always great to get your perspective. Opus Global Head of Energy Analysis. Thanks.
Thanks, guys.
Well, coming up, over 146,000 U.S. auto workers are set to go on strike this week if a deal is not reached. We are going to break down what this means for the auto industry next.
I am here with Josh Lipton. He is our new anchor, and he's here with 3 things that you need to know. First of all, tell us how you got into the reporting game.
Because of Aunt Rhoda. She was just a battle-tested veteran news executive. Used to always have the cigarette in one hand, the glass of Jack Daniels in the other. Very old school. And after college, I was kind of bouncing around, and Aunt Rhoda said, I think you should try journalism. And that was it.
And you listened to Aunt Rhoda.
I always listen to Rhoda.
What has been the favorite story in finance that you've covered?
Probably covering Apple. You know, I first got out to San Francisco. I'd never covered tech before. And CEO Tim Cook said, let's talk about earnings. It was a big deal, and it was just fun to talk to Cook. I think he actually genuinely enjoys himself, which, as we both know, not every CEO always does.
NFL season kicked off. Do you have a team?
I am, as you know, Julie, I'm Bay Area born and raised. So 49ers, and I look forward to the Niners beating the Eagles and upsetting Brad Smith. I think that'll be a really nice entry into Yahoo Finance.
Do you have a favorite food?
As you know, I'm married to a proud Italian American, so it's Italian in my house. That's really not up to me.
What's your knowledge gap that you're sort of self-conscious about?
I appreciate cars tremendously, right? But if you ask me what I'm embarrassed about, I should know more about how cars actually work and be able to repair them. That is a knowledge gap, Julie, I'm a little embarrassed about.
Are you a fix-it person generally?
No, I'm terrible. I can barely work a microwave. I'm awful.
Welcome back to Yahoo Finance Live. We are watching shares of Oracle dipping here, down more than 4% on the back of their latest quarterly results. The company missing on revenue, but beating on earnings. Earnings coming in at 86 cents a share. Total revenue at $12.5 billion. That's up 9%. And cloud revenue, $4.6 billion, up 30%. That, of course, is a big number investors are watching, just given what we have seen in terms of slowdown in tech investments on the enterprise side of things. The company highlighting the growth they have seen in cloud infrastructure revenue. That was up 66% year on year. And also, Shauna, I hate always highlighting the AI part, but of course that is what investors are watching here. In this statement that was released from Oracle, Larry Ellison specifically talking about the momentum they are seeing on that side, saying that as of today, AI development companies have signed contracts to purchase more than $4 billion of capacity in Oracle's Gen 2 cloud. That is twice as much as the company booked at the end of Q4. The stock, though, seeing a bit of a pullback right now.
Kiko, I wish you could see my screen. I literally had the same paragraph highlighted here in this release, but it really just speaks, one, to the enthusiasm with Oracle's business since the start of the year. We know that they have outperformed many of their competitors within the space, a lot of that because of the hype surrounding AI and what exactly that is doing for their business and could do for their business down the line. But cloud infrastructure, that was the other line that jumped out to me here. Revenue there of $1.5 billion, up 66% year over year, like you said. So one of the beneficiaries here of the AI frenzy. And also Safra Catz, the CEO of Oracle, in this release, is saying that cloud infrastructure revenue, the growth that they've seen there, is much better, much faster than their competitors within the space. But still, though, despite all that, the stock moving lower here, off just about to 4%. We are just days away from a possible UAW strike. The current contract expires on Thursday, and a complete work stoppage could be costly to the U.S. economy. Joined now by Yahoo Finance's Pras Subramanian and Rick Newman to dig a bit deeper into the current offers from the auto giants. Hi there, Rick, and hi there, Pras. And also just the potential political implications of all this. So, Pras, first to you. You're the expert on this. I know you've been following this very closely. We've seen some offers put forward by the large, or by all three of the large automakers here in Detroit. How do they compare to each other?
So we just had Stellantis submit their offer on Friday. They mentioned that they've been working with the UAW over the weekend, and they submitted possibly a second offer, a counterproposal that's happening today. We don't know the details of that, but as you can see right now, about a 14.5% wage increase for the lifetime of the contract, $6,000 one-time payments for inflation protection, also $4,500 inflation protection payment over the next 3 years. Talking about things like improving base pay for part-time workers, improving the acceleration timeline to get to higher wages from 6 from 8 to 6 years. Part of the big thing you're noticing here is the UAW wants the end of tiered contracts, right? And the thing with the kind of the staged progression is they don't want that. They want a 90 days to get to that top wage, right? Not 8 years. They want COLA benefits or cost of living adjustments. They want that built into a contract. The problem with the automakers is they see that as that could be unlimited. We don't know what inflation could be in the future years. We can't just have an open-ended expense. So we want to give you a defined $5,000 payment, $6,000 payment. So that's what all of them are sort of doing right now, trying to get to where the UAW wants. But the UAW has some really strong demands, like a defined pension plan for one thing, which is a lot.
Rick, there's a lot riding on this for President Biden as well, not only because he has said he's the most pro-union president, but also because the UAW hasn't necessarily gone all in on his re-election campaign. They have withheld the endorsement for the president. What do you think this means politically for this administration and the president if, in fact, negotiations don't reach a resolution and we do, in fact, see a strike?
I think there's a lot more downside than upside here for Biden, given that even since he's been a candidate in 2019 and 2020, he has thoroughly embraced unions, and he has done things such as in the several of the big bills he has signed, the infrastructure bill, the semiconductor bill, the green energy bill. Many of the requirements for getting the tax subsidies in those deals is that the work has to be done domestically, production has to be done domestically, and it has to be done by union workers. So he has really backed the unions. And the perplexing part about this is, the unions represent only 10% of American workers these days. In the manufacturing sector, where most unionized workers are, it's only about 15% of GDP, whereas the service industry is 86% of GDP. Almost all GDP is in the service sector. And, ask yourself, when was the last time you heard President Biden saying, we've really got to get behind the service sector and those white collar workers? We've got to rebuild the white collar economy. The answer is never. So he goes around to bridge reopenings and factory groundbreakings, talking about how he's revitalizing the blue collar workforce. It's only 10% of the total labor force, and it's probably never going to be much higher than 10%. So Biden and his people wonder, why is his approval rating so low, even though the economy is doing pretty well? Maybe part of it is he's going around talking to only 10% of the workforce in the United States. So if something goes wrong with this strike and it really does shut down the auto sector, cause car prices to go up even more, I think a lot of people are going to say, hey, those are your guys, Biden. Why aren't you fixing this? And if it goes away like the UPS strike did, I don't think anybody's going to give him any particular credit.
So if we do see a strike, obviously it sounds like this could pose a huge risk here to Biden in the re-election. But Praz, where talks stand today, the negotiations, the demands, when it comes to the UAW not backing down, what the three automakers, what at least it seems like they're willing to negotiate or agree to at this point, how likely is a strike?
They're still negotiating. There's a lot of talk happening right now. I spoke to Garrett Nelson of CFRA, and he thinks that, quote, that the two sides are miles apart and they see a strike happening sooner rather than later. Dan Ives said in a note today, a 15% chance of making a deal. So low consequences there. But I want to kind of address what Rick was sort of talking about here. The reason why the union is so strongly favoring potentially having a tough stance here is because as the EV build out happens, new EV batteries plants, new EV factory plants, they want to be able to have union representation there, and they want to be able to represent them and get big contracts for those new plants. So it's really important for them to actually win today or win this week, and then also for the future. So I think that's sort of what's happening right now. And you're right, the economic costs are pretty massive. We had a graphic up there of saying, I think if a 10-day strike happened, it'd be a $5.5 billion hit to U.S. GDP and potentially local economic recessions in the states of Michigan and other states like that that are tied to the auto sector.
So, Rick, let's pick up on that point that Praz just made. I'm thinking back to a year ago when the president announced the Inflation Reduction Act. He was very vocal. He said these will be good, paying union jobs. And a year later, there are some questions within these unions about whether, in fact, that promise can be kept in this EV transition. You heard Pras just talk about the potential for, if there are wage increases, will prices have to be passed down to consumers? Will that slow the transition? I mean, in the context of this big bet the president has made on the transition to electric, what does it mean if this does hit a snag?
Well, and another factor that you didn't mention, Akiko, is electric vehicles. To make electric vehicles takes fewer workers. So the UAW, to some extent, is actually opposed to more electric vehicle manufacturing because they think it will mean fewer unionized jobs. So this is complicated. I mean, we got the so-called battery belt popping up. That battery belt kind of goes north to south from Michigan all the way down to Tennessee and a lot of states in the South. And, those southern states are almost entirely non-unionized. And, for all the talk of the three domestic automakers, we've got a bunch of almost every automaker, including all the foreign automakers, does make cars in the United States. And almost all of those factories are non-union factories. And by the way, Tesla, also a non-union company. So I think another factor here for the UAW is they might feel like this is a bit of a last gasp, that their might within the auto sector has been diminishing. They might have a moment here because we supposedly have a shortage of workers, a labor shortage, and they might think that the president has their back. The thing is, I'm not sure Biden will take the union side if it really comes down to it and it gets ugly, because for Biden to take the union side, then he's dissing the three automakers that he kind of depends on. He's been touting the big three, the Detroit, they're not that big anymore, the Detroit three, as the ones who are innovating in the electric vehicle space. It's not just them, it's a bunch of others, Tesla included. So Biden's going to face a real uncomfortable choice if this gets ugly and both sides want him to pick one side.
Well, and you do wonder if the UAW does in fact get the concessions or more concessions than expected, whether that'll have a ripple effect, even so some of those non-union markets, because we have heard rumblings in Georgia, for example, about pressure against companies like Hyundai to raise those wages. So a lot riding on this. And of course, September 14th, the big deadline we are looking out for. Pras Subramanian and Rick Newman, thanks so much for bringing us that story.
Bye, guys.
Well, let's do a check of the markets sponsored by Tasty Trade. We did see green across the board at the close there. The Dow up 87 points on the day. The S&P 500 up 29 and the Nasdaq up 156. Tesla, the big mover on the day on the back of that big upgrade they got from Morgan Stanley. Well, coming up, we are going around the horn and checking in on some of today's top trending stories. Ali Canal and Josh Schaefer, as always, standing by with what to watch. What's on tap?
Hey, Akiko. Well, as you know, the chicken sandwich wars created some pretty high expectations, pun absolutely intended. But could the battle be turning cold?
Yeah, Allie, I mean, I think sometimes we think those chicken sandwich wars have maybe become a little bit more like watery eggs to some extent. We'll tell you how Popeyes plans to make those sandwiches a little bit warmer and get them to you faster next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined as always by Josh Schaefer, Praz Subramanian. We have quite a few stories on our docket today, but Praz, I know you're looking into the luxury watch space.
Yeah, Swatch, known for their, obviously a big name in the watch industry, and they've been doing these collabs recently with Omega. That was a huge, last year, everyone wanted one. Lines out the door outside Swatch stores everywhere. It kind of tapped this nerve, or hit the nerve of people wanting these high-end luxury goods at cheaper prices, or just like they want that collaboration sort of vibe. But recently they announced a potential Blancpain sort of combination, the Scuba 50 they're calling it, the 50 Fathoms Blancpain watch with Swatch. People thought, this is gonna be a big deal. Well, it was. We saw long lines across the world. Dubai, London, New York, Houston, Las Vegas.
Wow.
People lining up to get this watch. And look, I was surprised because, look, I think it's a pretty cool watch, but I didn't think many people knew the name Blancpain so in depth, so big. It's a really in the know watch brand for kind of watch heads, right? I guess I was wrong. People want this watch. They want this. I think maybe they want to resell it. I have no idea.
Yeah, Praz, I was curious just like what this means for the overall watch moment right now as far as where sales are at and where the collector's market's at. Like, are these companies going to collabs, I guess, to bring people back into like spark sales, or has that watch market still been hot over the last couple of years or last couple of months? Like, where's it been at?
So the new market has been still pretty strong in the steel luxury market, steel luxury segment of it, not the high end, platinum and gold and all that stuff. But the used market has been kind of weak, kind of suffering. And I think maybe this is an area for new brands to kind of find innovation with these collaborations and to tap into the new market for watches. It's a number of things here, right? It's the hype, it's the Instagram, it's the hype watch, it's just wanting to be associated with a brand like Blancpain, I guess.
And it gets at like the shoe drop culture too, right? In like scarcity, I think, and just like the fact that it seems like consumers are just really into that right now. That you can have something that is only a limited quantity that other people can't have, et cetera. It seems like just whatever the product is, people are getting it.
I just want to say one thing quickly. You cannot buy this watch online. They can only be bought in stores, and that created the havoc, the mania outside of the retail locations.
I wonder how long people are waiting.
I know. Those lines looked really long. And also $400 price point, I guess, relative to the prices of some other high-end watches. That's a pretty good steal. But I don't know, Praz. I'm not really a watch girl, so I don't think I'm the person to weigh in on this. I just don't think it looks that cool.
For $400, no, I don't know. It's pretty expensive.
It kind of looks like the watch you get for free in like a cereal box, and you're like, oh, I got this. Maybe I'm in the wrong. I don't know.
I mean, someone we work with made a joke that another competing news org called it the plastic Blancpain. So, it's definitely out there, Ali, like for sure. I guess the sort of the demand, the desire for these watches, something that people, again, I was surprised by it. But Swatch, multi-billion-dollar Swatch company or watch company, they are aware of it. They know how to. They just revved up the machine, the hype machine. They revved it up and they got it going again.
Yeah, and the brand name too.
Yeah, I think it's inward trends that we've seen from other resellers too. We interviewed the Poshmark CEO recently, and he said still that a lot of the luxury brands are what is selling right now, and that's a story I have my eye on today, guys. Is just overall sales. We got retail sales for the month of August coming later this week on Thursday, but Bankrate out with a survey ahead of that talking about spending coming for the fall, specifically for holidays. They're saying 2 out of 5 people are saying that spending is going to be less this year because they're feeling like their wallet's a little bit squeezed. But then interestingly enough, Pras, you made that face about holiday spending. 50% of people said they plan to spend on some sort of holiday before Halloween. And then 12% said they already started spending on it in August. Wow. I think you see a lot of people start spending on the sales, right? We just had a lot of back to school style sales. And if depending on who you're buying for, what kind of holiday shopping you do, I guess it kind of makes sense that it starts in August now, starts in July. I mean, think about even Prime Day. If you were really thinking about Christmas and you knew what you wanted to buy, I guess there were some deals out there to buy.
I mean, you go ahead.
Well, I was just going to say, I am not one of those shoppers. I definitely wait until December, and then I'm panicking and having to order online, or usually I don't even have time to order online. I have to run to the stores and order there. So I think November is the sweet spot, I think. But to your point, a lot of sales and discounts, I think, are a big driver.
That's why I think Black Friday is the perfect day for the beginning of the holiday shopping season. You get all the deals. It's right up close, right next to the holidays. I want those gifts delivered. I don't want them in my house. I don't want to be buying them now and having to store them now. I think with the same Bankrate survey, 37% begin at Black Friday. Yeah. I think that's sort of where we are now. That's where I'm at potentially. But I'm like you, Ali. December 15th, I'm still buying something. I'm like,
I'm
is it
so
gonna get
bad.
there?
I'm
Is it
so
gonna get there?
bad.
Oh,
I
no?
should not be that late with my shopping. I really shouldn't, but
But it
just
does
comes
feel
up
like,
quick.
it seems like I've seen a lot of pictures online too, though. The holiday shopping gear is already out in full force, right? And has been for like a month.
yeah.
Say of like a Walmart, even just like Halloween gear.
That came
It
out
seems like-
early August.
Yeah, some Thanksgiving stuff already seems to be out. I saw pumpkins were out in New York City already today.
I'm ready
People-
for Halloween.
People are selling
I love
pumpkins. I mean, it's what, September? It's September 11th. We're only a little bit over a month away from Halloween. Like those decorations make sense. So if that's counted as part of the holiday spending, then I get it. I think it's Christmas that feels far away, and Hanukkah feels far away
it's
until
still
you get past.
hottest.
Yeah, it's 90 degrees outside, and we haven't even really gotten there. But
I want to pick up on the other point you made about how consumers are feeling about their shopping in the holidays. I feel like that happens every single year because you are, even though, yes, economic environment right now, not great, high interest rates, inflation obviously still a problem, but I think every year you approach the holiday season not expecting it to come so quickly, and it really does come fast, and you know you have to spend a lot of money in a relatively short amount of time. And I think that automatically makes you anxious. So I feel like that happens every year, no matter how good or bad the economy is doing. That's just my hot take.
What changes within a year that you come back to the holiday season and like now you feel rich and you're ready to spend, right? Like no one likes, I think, how much they spend toward the end of the year. I think a lot of people's credit card bills go up, right? And it is just a sense of anxiety. I think that's a very fair point. Like November and December, you really just are kind of like, whether it's flights to get somewhere for the holidays, whether it's paying on actual goods or something, or even just food if you're the host, the bills just go up. At a time when a time when everything's more expensive. Oh, you want to spread out the holidays?
Spread it out. That's why you got to buy in April, May. I don't know.
Oh, so that's why you shop early for the holidays. All right, I'm with that.
You get that Blancpain 50 fathom.
Exactly. You got to go to those stores though to purchase. So that's the key there. But you know, while consumers might not be loving the approach for holiday shopping season, it's similar to the chicken sandwich wars. And yes, they apparently are still ongoing, but they're slowing down. Popeyes was a leader in this chicken sandwich craze. If you remember, back in 2019, 2020, they were selling sandwiches so fast. There were lines out the door, similar to your watch story, definitely. But now we've seen same-store sales slow significantly, which you're seeing on your screen right now. And that comes as a lot of people aren't returning to the stores in the quantity that they were to get these sandwiches. Now, there's also been problems with the rollout of these sandwiches, whether it be, orders not coming in correctly, the sandwiches aren't as hot as they've expected. So Popeyes is doing a lot of innovation in their kitchen to try and solve this. I just want to tick through some of the things that they're doing. They're doing innovative workstations, automatic batter makers, redesigned packaging, more pilot spaces. So really leaning in on the automation factor here. Also a broader menu. Wings, for example, that's been a really hot ticket item that's been doing well while they're trying to revitalize their business. But you also have to remember this is a fast food chain that has a relatively small footprint relative to some of the other fast food giants out there. There's certainly a lot more room to run. Maybe some of these changes will help revitalize the chicken sandwich.
Yeah, to me, I think at a high level, it's just a company that's looking to probably get some margin improvement there, right, and just become more efficient because the sales are down a little bit. Because at the end of the day, a chicken sandwich is a chicken sandwich. There's always a market for people that will want a chicken sandwich, but that market isn't like exponentially growing forever. This chicken wars thing has just been absurd. It's a chicken sandwich. They're pretty good.
You said it's a cold war.
It is a cold war. We just still talk about it, but there's nothing actually going on. They're just still making chicken sandwiches, and they're still pretty good. If you want one, you go get one.
That's the line. A chicken sandwich is just a chicken sandwich.
It is. That's all they have, too. It's Popeyes. Like, they kind of just have chicken sandwiches.
Well,
what else are you going there for?
I want to know one quick thing. I did note in their materials for this, they said that they waited on improving the kitchen stuff because they don't want to impact quality of the food. I'm like, it's Popeyes. Like, it's fried chicken. Like, what are we talking about here? But, fried chicken is great. Automatic battering stations, I get it. They're trying to make it a more cost-efficient, maybe faster, less error-prone business. I mean, it's chicken sandwiches. I mean, I feel like now, I think there was that whole, again, the Instagram, like, I got the Popeyes chicken
and
sandwich.
And the Twitter wars, they were all going back and
they were very good at the marketing.
The marketing was great.
Some group text, people were talking about how they went and they got it. I'm like, it's a chicken sandwich, but you're right.
Well, I don't know. To some, a chicken sandwich is a lot more than just a chicken sandwich. We'll have to taste test this and debate it.
Yes.
But we'll be right back on the other side of this break. More Yahoo Finance coming your way. Stay tuned.
This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Week-long series on student loans. After a 3-year pause, the long-standing payment freeze is ending. Federal student loans started accruing interest on September 1st, and payments are set to resume next month. Millions of students are on the hook to pay in June. The Supreme Court blocked President Biden's student debt cancellation plan, which would have canceled up to $20,000 in loans for each borrower. Here to talk about that and more, we want to bring in Skye Perryman, CEO and president of Democracy Forward. Skye, it's good to see you. So first, before we get into the litigation of all this and maybe what we could see ahead here in the coming months, what do student borrowers need to know? Because I think millions are a little bit confused given the fact that we've had some conflicting rulings over the last couple of months, and then also just with everything changing. What do they need to know?
The main thing student borrowers need to know is that President Biden and his administration is committed to taking action in order to relieve student debt. While the Supreme Court did strike down the first debt program, the president has announced a number of other programs, including one that is to take effect immediately, which fixes glitches in the system and could provide an on-ramp for student borrowers to begin paying again, as well as some relief based on earnings and family size. The president has also announced a Plan B under the Higher Education Act, which will be moving through the regulatory process and will hopefully be able to provide borrowers even more relief.
Yeah, so let's talk about the Higher Education Act. I mean, this is an act that was signed, by Lyndon B. Johnson, right? So this has been in place, but how is the White House utilizing this, and what does it ultimately mean for those who are shouldered with this debt?
Right. So this is a law that has been in effect for some time. It provides clear authority for the Secretary of Education to waive or modify or compromise debt, which is what the president has announced the intent to do, and the Secretary has announced the intent to do. There will be some regulations and regulatory process that has to take place before there's immediate relief here, and that is happening pursuant to announcements that were made earlier this summer.
Skye, could we see legal challenges to that? What does that look like?
Well, these days, unfortunately, there are a number of groups that are intent on seeking to challenge student debt relief. But it's very clear that there is authority under the Higher Education Act. This is one of the bedrock laws of all higher education payment systems. And so, we will obviously be watching that. There has already been one legal challenge utilizing with a different part of the plan that a federal judge has already dismissed. But I do think that there could potentially be challenges, even though this is clearly lawful and really important for borrowers in order to get the relief that they need.
So what does that ultimately mean for the timeline of relief? I mean, you're talking about students that have not had to pay on their student debt for years now because of the pandemic pause that was put in place. What are they ultimately looking at if, as you say, there is still a bit of a legal challenge or legal road ahead?
So the lawsuit that had been filed against the more immediate debt relief initiatives has already been dismissed for lack of standing. So that's very positive for borrowers. But unfortunately, because the Supreme Court did strike down the first student debt relief attempt, a lot of the broad relief will have to take place after a regulatory process. That said, the administration has already taken swift action to provide for some borrowers an on-ramp in order to begin payments again, as well as some immediate relief that could save families almost $1,000, approximately, some families approximately $1,000 a month through fixing various regulatory issues with the plan. So there's a variety of legal pathways here, and the main thing is some borrowers will be able to get relief soon, and then there will likely be more relief on the way with the Higher Education Act.
So I realize there's a regulatory process that still needs to play out, but when you compare it to the HEROES Act, and you're talking about the path forward with the Higher Education Act, how does that differ in the scope, the scale of the relief that's available?
That, you know, a lot of the scale will be determined in the during the regulatory process, but the Higher Education Act does provide pretty comprehensive relief. It's just slower than the HEROES Act was. The HEROES Act was an act that is clear that the president can use in emergency situations. Unfortunately, the Supreme Court struck down that debt relief under there. And so now this is going to be a bit of a lengthy process. But the important thing is the administration has already announced a variety of other more immediate relief through the regulatory, a variety of other more immediate relief that may not be as large as the Higher Education Act, which will take some time, but is to go into effect in order to provide that on-ramp for borrowers.
All right, Skye Perryman, CEO and President of Democracy Forward. Thanks so much.
Well, 22 years ago today, Wall Street firm Cantor Fitzgerald lost 658 employees in the September 11th attacks. In the wake of the tragedy, the Cantor Fitzgerald Fund, a relief fund, was born to help those affected by 9/11 and also to contribute to other worthy causes worldwide. To date, the organization has distributed more than $369 million in aid. Cantor Fitzgerald CEO Howard Lutnick joined Yahoo Finance this morning to discuss the anniversary and the impact the relief fund has had.
We lost 658 people, but these were all our friends. I lost my brother, Gary. He was 36, my best friend. But that was true of everyone because the policy of the firm was, let's hire our friends. So you think you lost all those people. We've got to help those families. So the rallying cry that rebuilt this company was, you're going to come join us. We give away 25% of everything we make for the next 5 years, and we take care of these families. So we raised those families in those first 5 years $180 million. We paid health care for all 658 families. And that became the foundation on which Cantor Fitzgerald was built. And now all the people behind us, they're all waiving their days paid today. We turned it to taking care of 150 different charities around the world. We have celebrity ambassadors come in. We've got Dave Portnoy behind me. We've got Eli Manning, Matthew McConaughey. They're walking around the floor. You'll see like some tall people walking around, basketball players, Rangers. Everybody's here trying to make it an incredible place to raise money today.
We see you always have a video appearance every year. We do. We love it. We love it. It's just a signal of your firm's resilience, Howard. You and I have talked in the past, and my heart goes out to you with all the loss that you experienced, both personally and professionally. But I want to talk to you about both the resilience and how you got the celebrities involved in this event, and then just the goal and the impact you're trying to achieve in this year in particular.
So if you're going to raise money for charity, we want to take care of our employees' charities, customers' charities. So what we did is, if everyone's going to waive their day's pay, and everybody at Cantor Fitzgerald waives their day's pay, I don't want them going home and telling their kids that they worked their tail off today and the money went to somebody else. So we invite celebrity ambassadors in, and gentleman takes a picture with Eli and Peyton Manning, and he goes home and shows his kids, look, and his kids think, Dad, you have like the coolest job. And that's the idea, to make the energy here very positive. It's a very, very tough day for me. But all these employees behind us, remember, Cantor Fitzgerald had 2,000 employees on 9/11. We went down to, we started the new year of 2002 with just about 1,000. And now we have 15,000 around the world. We've got Cantor Fitzgerald. We've got BGC, the world's most important wholesale financial service company. And we've got Newmark, which is now liquidating the Signature Bank loans now. So the company is doing great things, but all of them are donating the money to charity today to make it a great day, and we can take care of so many people. Bringing everybody together and make something positive on the toughest day.
And Howard, you have an entire generation who didn't have to live through this experience. What sort of legacy do you want to pass on through the work that you're doing at the fund and to the financial community as well? You have a lot of graduates who are going to be perhaps coming into the financial industry who really didn't live through any of this.
I'm walking on the floor today, walking over to sit in front of the camera, and a young lady comes over and says hello. She was Matt Leonard's daughter. So one of our lawyers who we lost on September 11th, she was 6 months old at that time. But now she's joining us as part of, we offer a job to any kid of anybody we lost. So we've got to bring them in, show them what it's like, show them how you can care and how you can engage your community and your families all together. So the idea is keep 9/11 alive, but do it in a very strong and very positive way. Get the whole Wall Street community, the whole financial service community engaged, and show them that we can do something great, even in the shadow of something terrible. And that gets young people involved. You got Dave Portnoy with his 4.5 million followers on Instagram, tweeting out his trades. Charlize Theron, she did a $5.2 billion U.S. Treasury trade today. So that's pretty cool. Pretty cool.
Howard, how much are you looking to raise this year through the Charity Day? And what would you like the legacy of Cantor Fitzgerald to be?
So last year, we raised $12 million today. So now today's a Monday, and Monday's not as busy. As you said, the S&P is sort of up like 1/3%, not particularly exciting. But hopefully we'll get the world engaged and excited. We start this in Asia, and then we do it in London, and then we finish it here. So I think we're running about the same as last year. So I hope we raise $12 million, which will be good on a Monday. That's pretty good. And the legacy of Cantor Fitzgerald, we suffered the worst loss. You can't imagine losing all the people who produce money for your company. That's not possible, right? It's not even a concept. It's not on the menu. And so for us to rebuild and to do it with grace and taking care of the families and taking care of so many others would show that our resilience and the resilience of America is positive, it's uplifting, it's strong, and you're never, ever going to keep it down.
Our thanks to Cantor Fitzgerald CEO Howard Lutnick there. We'll be right back. is closing time here at Yahoo Finance. Here's a look at some of the top stories and trending tickers. The Food and Drug Administration's authorizing updated COVID vaccines from Pfizer and Moderna Monday. These shots closely match the variants that are currently circulating, and it comes as we've seen cases and hospitalizations on the rise. The Pfizer and Moderna shots should be available soon, with the CDC expected to approve the vaccines shortly. We're watching shares of Oracle after hours. The stock under pressure after reporting fiscal first quarter earnings. The software giant reported adjusted earnings of $1.19 a share, which came in above expectations, but revenue came in lightly at $12.45 billion. Oracle chairman Larry Ellison touting the company's AI business in the earnings release, saying it has signed contracts for companies to purchase more than $4 billion of capacity in Oracle's Gen 2 cloud. And shares of Tesla are soaring on an upgrade from Morgan Stanley. Analyst Adam Jonas raising the stock to outperform and his price target to $400 a share. That is the highest on the street. All of this because of Tesla's Dojo supercomputer. Jonas likened it to AWS for Amazon.
Let's take a look at what to watch on Tuesday. First up, Apple's big event, its most important product unveiling of the year. The tech giant is expected to unveil its new iPhone 15 and Apple Watch Series 9. The reveal coming at a critical time for Apple. iPhone sales have been declining in recent quarters. Shares fell more than 6% in a two-day period last week on reports that China was banning iPhones for government workers and also for state-owned firms. And Google heading to trial. It's a big test for cracking down on big tech. The DOJ will be making its case, trying to prove that Google abused its monopoly in online search. The lawsuit against Google is a huge test for the U.S. government, which is trying to use a 133-year-old law to rein in several of the country's tech giants. Now that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here 3 p.m. Eastern Time tomorrow. Have a great night.